This video will walk you through incremental analysis for replacing or retaining equipment. In a decision to retain or replace equipment, management compares the costs which are affected by the two alternatives. Generally, the relevant items to be considered are the variable manufacturing cost and the cost of new equipment. The book value of the old machine is a sunk cost, which does not reflect the decision. Remember, a sunk cost is a cost that cannot be changed by present or future decisions. So just a quick reminder of what is book value. When we talk about book value, that's simply the cost of the equipment less its accumulated depreciation. So any book value means that we have not depreciated the piece of equipment totally yet. And if you just eliminate that piece of equipment and don't get any trade-in value, that book value becomes a loss on the income statement. So instead of depreciating it and impacting our income statement, it'll be a loss. Both have the same impact on the income statement. It reduces net income. So it's a wash. So, and if there is a trade-in value, or trade-in allowance or cash disposal value, that will be considered in our analysis because that is a relevant piece of information. So again, book value of the old machine is a sunk cost and does not impact our decision. So let's look at an example and see how this really works. So here we have Brooks Timber Corporation uses a machine that removes the bark from cut timber. The machine is unreliable and results in a significant amount of downtime and excessive labor costs. Manager is considering placing the machine with a more efficient one, which will minimize downtime and excessive labor costs. Data are presented below for the two machines. So, for the old machine, the original purchase cost was $340,000. That again is sunk cost and irrelevant. The $430,000 for the new machine is relevant. Accumulated depreciation, we don't care about it because again it's part of the old piece of equipment. Estimated useful life for both is 5 years. It is estimated that the new machine will produce an annual cost savings of $95,000. So that $95,000 we'll see every year for 5 years. And so it's important to realize when you look at and have a decision about purchasing a new piece of equipment, the annual savings you have to take for the full life of the machine, not just the first year. The old machine can be sold to a scrap dealer for $8,000, so that's important. That's relevant information. Both machines will have a salvage value of 0 if operated for the remainder of the useful lives. So let's see, doing an analysis, whether or not we should retain or replace the old equipment. So the first thing we want to be thinking about is, do we have any cost savings for operations? Well, if we retain the old equipment, there would be no cost savings. We would be incurring the same net income. On the new pieces of equipment, there was an annual cost savings of $95,000 per year times 5 years. So that gives us $475,000. And that truly is a cost savings, so that would increase our net income, remember future, over those 5 years by $475,000. Then we have to ask ourselves, is there any cost that's going into replacing it? And it would be, we'd have a cost for the new machine, nothing under retaining it, but if we replace it, it would cost us $430,000. So that's a cost. There is no other cost, but we do have the proceeds from the sale. So sale of the old one. Again, we would not get it if we retain the old equipment. We get it if we sell it by replacing it. So that $8,000 increases our future net income. And therefore we can see what's the change in our net income. Well, if we keep the old piece of equipment, there is no change. If we add this up, we get 483 minus 430. That would be 53,000 here. And that would be the same here. So there's an increase of our future net income of $53,000, which says that we should replace the old piece of equipment. Now, of course, to see this and for the company to get this savings, they have to use that new piece of equipment for 5 years. But the key is the savings in operational cost more than offsets the cost of the new piece of equipment, as well as it's offset by the $8,000 for selling the old.